All right, let's jump right into this explainer. Think of what we're about to cover as a survival map. I built this to fundamentally change how you navigate your own mind when you're in a trade. Look, as someone who spent years in the trenches analyzing markets, I'm playing the role of your mentor today. We are going to map out the 12 distinct emotional stages every single investor goes through, turning this otherwise chaotic journey into a clear, sequential, and highly predictable learning path. I've been exactly where you are, feeling the absolute roller coaster of the market. And that's why this quote is the ultimate truth of investing. When you're just starting out, it's so easy to look at a price chart and just see math, right? But those numbers, they're really just the numerical residue of human emotion. When you see a massive short position from the major banks, that is cold calculation standing directly opposite the collective desperate hope of everyday traders. So here is our map for today. First, the myth of rationality. Second, the ascent to euphoria. Third, spotting the market turn. Fourth, the descent into panic. And finally, number 5, the 13th stage, which is mastery. Okay, part 1, the myth of rationality. We have to kick things off by completely shattering the biggest lie retail investors are taught. See, markets are not these calculated, perfectly efficient machines. Human emotion is actually the underlying operating system running the whole show. The myth tells you that prices reflect all available information and careful, flawless fundamental analysis. But the reality? Fear, greed, hope, and regret aren't bugs in the system, they literally run the system. If you don't realize this right out of the gate, you're going to constantly mistake your own emotional reactions for brilliant market insights. Moving on to part 2, the ascent to euphoria. Let's walk through the first half of the cycle. This is where we make our money, sure, but it's also where we blindly step into our biggest traps. Notice how the dominant emotion slowly, almost invisibly shifts. Down in disbelief, the trap is paralysis. You know the feeling. You've been burned before, so you just don't trust the rally. Then, by hope, the trap is taking profits way too early. In optimism, the trap is recency bias. You start thinking the easy money is just going to last forever. Move up to belief, and the trap is ignoring hard data in favor of a good narrative. By thrill, the trap is over-leveraging. And finally, euphoria traps you with a total suspension of disbelief. You literally feel invincible, violating your own position sizing rules right as the market is setting you up for a massive, massive fall. Now, your internal feelings actually map directly to rising price trends. Pay close attention to how volume surges visually precede that incredibly dangerous transition from belief to thrill. In the early stages, volume is pretty low. But then, as the financial media starts hyping the market and the general public floods in, volume spikes massively right alongside those parabolic price charts. Look, when you catch yourself calculating what luxury car you can buy with your unrealized profits, the data usually shows the market is at a historic extreme. So, how do you survive the thrill trap? I want you to start using this daily reflection journal template. It's designed to mentally prepare you for the violent transition between euphoria and panic. Write down exactly how invincible you feel right now. Detail your absolute certainty that the market will just keep rising. When the market inevitably turns, and it will, read that letter. It is incredibly humbling, maybe even a little embarrassing, but it forces self-awareness and shatters that illusion of control. And alongside your emotions, physically write down the commitments of traders, or COT data, that tethers your feelings right back to objective reality. Part 3, spotting the market turn. This is where I hand you the X-ray vision you need to actually see the top before the crash happens. Right here is the crucial point. Look at how retail investors are maxing out their long positions, while the smart money professionals are quietly building massive shorts. The Commitments of Traders report is absolutely your ultimate tool for identifying trend exhaustion. During those thrill and euphoria stages, the dumb money, the late arriving public, is going all in. But the COT data will show you that commercial swap dealers, the big banks, have built up historic short positions. They are happily selling the public exactly what they're frantically clamoring to buy. This contrasts that high-flying feeling of euphoria with actual cold market data, showing you how to visually identify price exhaustion using volume and open interest divergence. You might feel like the market is an unstoppable money-printing machine as prices make these vertical, parabolic leaps. But pull up the open interest indicator on your chart. If the price is making new highs, but open interest is actually declining, well, that means the smart money is quietly cashing out. The fuel for the rally is gone, even though the hype is at its absolute loudest. You'll want to print out this simple checklist for identifying signs of market distribution at the complacency stage. Complacency happens when prices stop going vertical and just trade sideways. They often form these classic transition chart patterns like double tops or head and shoulders. It feels safe, right? Like a healthy consolidation. But run your checklist. Is managed money dropping? Yes. Is open interest falling? Yes. Are retail traders holding? Yes. Listen to me. This is not a dip to buy. This is a distribution top, where professionals are literally handing the bag over to the public. Let's look at your step-by-step process for plotting cycle stages on live price charts using the commitments of traders' data. First, locate the COT index. If it hits the 90 to 100 range, you are mathematically in the euphoria phase, regardless of how great you feel. Next, confirm that extreme reading with falling open interest. Finally, execute objective risk reduction. That means aggressively selling 50 to 75% of your position. You don't guess, you let the hard data override your greed. Part 4. The descent into panic. Now we enter the darkest part of the map. This is where you have to pivot from wealth generation to strict crisis management. They say markets take the stairs up, but the elevator down, and it's so true. Each stage of the drop has a very specific trap. In complacency, the trap is holding out hope for a rebound. In anxiety, the trap is averaging down into a losing position. Denial traps you in the sunk cost fallacy. By panic, the trap is margin calls triggering forced liquidations. Capitulation traps you into selling at the absolute bottom just to stop the bleeding. And finally, despondency traps you in total apathy, which prevents you from buying the absolute best opportunities of the new cycle. Now, these are the common cognitive biases that will actively trick you into ignoring the warning signs that a transition to the next painful stage is imminent. Recency bias makes you think every dip is a buying opportunity simply because it worked for the last 6 months. Anchoring keeps your brain fixated on that all-time high, making a 10% drop look like a steal. And the sunk cost fallacy? That's what traps you in denial. You refuse to sell because realizing the loss hurts your ego, so you hold on tightly while your account just bleeds. As volatility increases during market turns, you need to use a risk exposure worksheet to calculate your sleeping point. Proper position sizing is absolutely your best defense mechanism here. Look, if you are waking up at 3 a.m. in a cold sweat to check overseas markets on your phone, your position is too big, period. Position size isn't just about the math, it's about emotional regulation. You must reduce your exposure until that physical distress completely vanishes. If you find yourself trapped in that denial phase, immediately deploy these 3 specific stop-loss strategies to trigger objective risk reduction and protect your capital. First, violently sell down to that sleeping point we just talked about. Second, separate your long-term thesis from this specific trade. You can still believe gold or tech will go to the moon over the next decade while accepting that this specific trade is currently a loser. Third, set specific price alerts based on technical levels. When they trigger, you exit. No debates, no second guessing. When you hit panic and capitulation, you must follow these actionable risk management rules to the letter. Do not try to be a hero, just preserve what remains so you can actually buy the eventual bottom. Rule 1. Do not try to short a crash. Chaotic liquidations create violent snapback rallies that will completely wipe you out. Rule 2. If you are trapped in a crashing position, sell everything immediately to stop the pain. Just go to cash. You need to detach emotionally so you can prepare for the despondency phase, because that is where the absolute best buying opportunities in the next cycle are born. Part 5. The 13th stage, mastery. Our final destination is the one stage the market doesn't impose on you. It's one you have to achieve yourself. Mastery isn't about turning into some emotionless robot. That's impossible. It's about feeling the thrill or the fear, pausing and letting the COT data make the actual decision. When you feel that massive surge of invincibility, a master trader recognizes that feeling as a symptom of stage 6 euphoria. The emotion simply acts as an alarm bell to open up the commitments of traders report. If the data confirms extreme optimism, the master sells. The emotion is real, but the data is completely in control. So the next time you feel completely invincible in a trade, will you let that emotion dictate your fate, or will you consult the map? The cycle is inevitable, but if you follow this explainer, you will finally stop reacting to the market and start anticipating it. The market is going to cycle through hope, greed, panic, and despair over and over again for the rest of your life. The question isn't whether the cycle will happen, it's whether you'll finally be the one navigating it with a map, rather than being swept away in the storm. Check your data, watch those position sizes, and I will see you in the next cycle.